Welcome back, friends, and let me start with some more discussion with the corporate taxation. And this is one of the very valuable, very important question. Come to this particular page, friends. Chapter ID number and the page number, you can see it on the screen. And let me read the question. Netherlands Oil Corporation is a foreign company engaged in the exploration of oil and gas in all the countries, including India. In respect of its Indian business, the company has prepared the profit and loss account in accordance with Part 2(3) Schedule 6 of the Companies Act 1956. And such profit and loss account for the previous year shows net profit of rupees 65 lakhs of rupees. The net profit from the activities in all the other countries stands at rupees 550 lakhs of rupees. The company informs that while arriving at the net profit, as indicated above in respect of the Indian business, the following debits and credits have been made in the profit and loss account. Credits to the profit and loss account. Net agricultural income in India. Share of profits from firm engaged in the business in India. Amount withdrawn from reserve created few years back. Book profit was not increased by the amount transferred to such reserves. Profits from an industrial undertaking covered and qualified under Section 10B of the Income Tax Act. Profit from industrial undertaking covered and qualified under Section 80IC in the state of Sikkim of the Income Tax Act. Debits to the profit and loss account. Expenditure relating to 10B undertaking. 2. Depreciation for the current year under Companies Act 1956. 3. Interest on financial institutions not paid up to the date of filing of the return. 4. Penalty for the infraction of the law. 5. Proposed dividend. 6. Provision for taxation, income tax and reserve for bad debts. 7. Transfer to general reserve. 8. Provision for unascertained liabilities. 9. Expenditure relating to ATIC undertaking in the state of Sikkim. The following additional information is also provided. Brought forward book loss, depreciation allowable under the income tax rules, brought forward business loss and unabsorbed depreciation as per income tax law, loss rupees 7 lakhs and depreciation rupees 10 lakhs. The company has brought forward tax credit from 3 years back, rupees 5 lakhs. You are requested to compute the total tax liability of the company. This is actually one of the past final CA examination question for 16 marks. Of course, many more even earlier questions and subsequent questions I have taken up from examination types only. But this was like a very popular examination type question. So some of the language in the question I have not altered it. Some of the language, but that should have been logically altered. Like for example, you say Part 2(3) of Schedule 6 of the Companies Act 1956. So we should understand the latest company law as amended by the government from time to time. That means it is trying to say that all the compliance with respect to the company law that you have already done it. Go through the question, friends. Take your own time. I mean, I'm not in the hurry to solve this particular question immediately. Take your own time. Try to understand this question, and a lot of variety of points have been there here, and we'll discuss them step by step. Question like this, friends, first of all, let me tell you, in the examination condition, you guys should be able to solve it in max to max 20 to 25 minutes. Roughly, I'm just telling you. I mean, I'm not trying to say it's a very hard and fast thing. See, normally I will tell you, it's a 100 marks paper, you are given 3 hours. So 3 hours means 180 minutes. That means for 1 mark, you have around 1.8 minutes on an average. Plus you remove some time for revision and revision of your answer book and your question reading and kind of things. Average, on an average, 1.5 minutes. If this is a 16 mark question, on an average basis, if you say for 16 mark and 1.5 minutes for every mark, roughly around 24 minutes you are getting in your hand. But that is max to max time. And of course, in a full-fledged question like this, you can take little bit of extra time, like 2-3 minutes extra you can take in examination condition. Beyond this, if you take the time in examination condition, it is going to be expensive in terms of the time cost. And believe me, friends, when this question had come in the examination condition, majority of the students had found it very difficult. Very difficult. Because this question relates to the period of the initial years of the math. You know, I already told you that the concept of math under the law is not right from the beginning of our independence. No. It is not a very old. It has been introduced somewhere in early 2000, something like that. So, students of those years, when they had to manage it, they had to manage a whole new concept, whole new chapter during those days. During those days, it was a very popular chapter because every corporate assessee is subjected to these particular provisions and it created an extra burden. So, during those days, anyway, the chapter was important. Practical exposure of the chapter was less and the examination coverage during those days was high. So, institute, those days when they have set this particular, even the environment in which when this question was solved was also different. Like for example, today I'll tell you. Now today this chapter is quite an old chapter. I mean, it has got a lot of precedents. It has already got a lot of decided concepts. Today you also have many number of questions to practice. Are you getting it? So your scope of the chapter is quite different than compared to those students of the initial years of the math provisions. And at that time, such a big googly question had come in the exam. Most of the students were taken for a ride. And that was always the objective of the institute, because during those days, I'll tell you, all the papers were compulsory and all the questions were compulsory. So those days, papers were of different class altogether. Today, the institute by itself, the paper pattern is such that you have to solve question number 1 compulsory and out of few questions you are given the option. That already makes the question paper simpler for the students to manage. Comparatively, I am telling you. You can feel the difference. I'm telling you, you can feel the difference. Real difference you can feel. If 100% paper is compulsory, no choice. And you get paper with choice of 1 question altogether. Plus you have internal choice also sometimes. For example, question number 3 you have in that, they say that you do either A or B. Something like that. So those choices has made the question paper or the examination comparatively simpler to the students. And you guys are lucky. I'm telling you, you guys are really lucky. Because you are giving examinations in this era. Nowadays, students have developed a mentality, psychology that, out of the entire portion, some topics, so you can leave it in option. That kind of mentality students have developed. I mean, nothing wrong because institute has developed that mentality. Nobody to blame for. And students do it like that. That, oh, I'll leave this much portion in option because anyway I have an option. So that kind of pick and choose, students do it in every subject. The institute is, what should I say, encouraging that. But still I'm telling you, few chapters you can't do pick and choose. For example, corporate taxation, you can't do pick and choose. You can't afford to take a chance here that, oh, I'll leave this chapter. Impossible. Such a mistake nobody can do. So go through the question, friends, and take your own time. Thereafter, we'll start discussing, and a lot of things to be discussed and a lot of clarifications are to be developed. Okay. Let me start. Netherlands Oil Corporation is a foreign company engaged in the exploration of oil and gas in all the countries, including India. The moment this particular language has come, it is a foreign company engaged in the business of oil exploration, and it is into all the countries including India. This by itself brings us to the concepts of international taxation. The moment the word foreign company comes, I mean tax treatment with respect to a foreign company, it by itself means it is a part of your international taxation portion. So this particular company, the foreign company, is having the global operations, and in the global operations you have some operations carried out in India also. Okay. Secondly, by looking at this particular question, it is saying that this company has got a net agricultural income, it has got some share of profits from the firm, then it has got some 10B undertaking. In Sikkim also you have got some undertaking. It seems, clearly it seems, that this foreign company has got a permanent establishment in India. The concept of PE in the international taxation is very important. See, because in the international world, when there is all business done through the corporate entities, there are many foreign companies who do operations in our country or global operations. They do it, but they may not have a registered entity in India. And internationally, governments recognize it as a concept that foreign company is not registered under the company law in India because it is registered in the foreign country, but it has got a fixed place of operation in India, which is called a permanent establishment in India. So it is called as a fixed place of operations in India. So that fixed operation in India, but look at this, he has got agricultural income, it has got some Sikkim undertaking, it has got some qualified under section 10B or something like that. That is printed in the question. Okay, so looking at this, it has got operation in India. Fixed place of, it has got some fixed offices in India. Okay, if you have a fixed place of operation in India, then you will be liable for normal taxation in India as a foreign company. That means your income out of the Indian operations will be regarded as an Indian income. Keep this in mind. Will be regarded as a Indian income, and it will be liable for taxation in India. Full stop. Foreign companies, whether or not they are subjected to the MAT provisions or not, was always once upon a time a big question. was once upon a time, I'm telling you, a big question when there was a lot of judiciary debates, courtroom discussion and all that was going on. The concept which was already developed that if the foreign company has a fixed place of operations in India, then to that extent, it will be chargeable to tax in India. Subsequently, the law also with the passage of time got evaluated, amended from time to time, and we have some provisions. Wait a minute, I want you guys to bring your attention to some of the provisions. Yeah, here. Come to this page. Particularly the clarification of the foreign company and the MAT clarification. Okay, just look at this. Where a foreign company is resident of the country with which India has a treaty or India has no treaty. Okay, now in that situation, just understand the concept, friends, where assessee does not have any permanent establishment in India. So if you do not have any permanent establishment in India, then you will not be taxable. Then you will not be taxable. That means you do not have any permanent fixed place of operations in India. Okay. And if foreign company is of that country in with which India do not have any treaty, if it is not required for any registration under any law in India. If it is not required for any registration. So, for example, you may say that there is some country with which India has got no treaty and nothing of a connection with that country in the international world. So then we will look at it like that, whether foreign company is liable for any registrations in India under any law for the time being in force. And I'm telling you the important reference to any law here is with respect to GST. Of course, any law means any law, but the main focus is GST. For example, if you are supplying anything in India, that means you are liable for registration. That means if you are doing any damn business in India, you are liable for registration. And if you are liable for registration in India, then you are liable for MAT in India. But if you are not doing any supply in India, that means you don't have any business. You are just a company in that country, no business in India. That means, okay, no MAT in India. What the big deal? You don't have any Indian operations. So, two separate categories have been provided. Both of them are very logical. And both of them are on the same lines actually. Only the grammar which is used is, if there is a treaty, then there is a concept of permanent establishment used by the law. And there is no treaty, then the test of registration used by the law. With respect to the MAT. Now you come to the given question. Our Netherlands Oil Corporation. Our Netherlands Oil Corporation has got agricultural income. It has got some unit in Sikkim. It has got some 10B kind of reference kind of income, etc. Details have been given to us. It is also partner in some partnership firm in India. So definitely it has got some business in India. Now, this particular company is registered in which country? Practically, it could be Netherlands because it is saying the Netherlands Oil Corporation. Say for example. Now you will wonder whether with Netherlands, India has got a treaty or not. So that is not part of our portion, our syllabus. So you have to think further. Say for example, with Netherlands, India has got a treaty. Suppose India has got a treaty. Okay. So in that case, assessee should not have any P in India. Then MAT will not apply. But our assessee has already got a P in India. No doubt about that. That means MAT will apply. That means the MAT will apply. Okay. Let us assume that, for example, with India and Netherlands, there is no double taxation treaty. There is no treaty between India and Netherlands. Then the test is of registration. That whether this foreign company is liable for any registration in India. 100% yes into GST. 100% yes. Why? Because look at this business. Agricultural income. Agricultural income is not liable for GST. That company is a partner in the partnership firm. It has got a unit in Sikkim. So, because you have these activities in India, GST is 100% applicable to you. That means registration is required. You are actually registered or not, I don't know. But registration is required. And therefore, MAT will apply. So, this particular concept, whether the MAT to the foreign company will apply or not, by itself was one of the detailed discussion. Nowadays, the law makes it very clear. That this particular situation, if there is a treaty, that means country with which this company is already registered, and that country and India, whether treaty or not a treaty, whatever the situation, but looking at the question, it is sure and certain that the MAT provisions are applicable. Is that clear? Second point. The MAT also do not apply to all these categories of the businesses. But mind well, even with all these categories of the businesses, PE is always a good test. For example, I'll tell you, non-resident shipping business or non-resident aircraft business. For example, let's say Air Emirates is flying to India. Air Emirates is already flying to India and it is going back. If the Air Emirates do not have any permanent establishment in India, that means no fixed place of operations in India, correct? Then these particular provisions will say that, okay, MAT will not apply because you don't have only the fixed place of operations. That means even with respect to the specified businesses under this particular clause, the test of PE is always a very important test. Okay, so come back to this particular question. So Netherlands Oil Corporation, logically registered in Netherlands, global business. It has already prepared its accounts as per the Companies Act, as per the company law. So this language of the question is a bit older one, but you should interpret this particular question as the compliance of the company law is already done with respect to the accounts and all that kind of things. Okay, it shows a net profit of 65 lakhs. However, the global operations are 550 lakhs. Okay, so another clarification. See, now that we have already decided that the MAT provisions will be applicable to this particular company, in that situation, whether your profit of 65 lakhs will be taxable in India or the global income will be taxable, that is 550 lakhs. Okay. So because now we are talking about permanent establishment, that means your Indian operations, the concept is very clear that only your Indian income will be subject matter to taxation in India. However, what is the residential status of this company, that means this foreign company, is again not clearly defined, under this particular question. So for that also you should know the concept of residential status, but it appears that maybe this particular company is a non-resident company, because foreign companies with less than the specified turnover can be regarded as a straightaway non-resident companies. So when you are non-resident, in this situation, only your Indian incomes will be subject matter of taxation. So you will not be taxing 550 lakhs. That means if you have to start the computation, you will start the computation with profit as per P&L, and that is going to be 65 lakhs of rupees. Then it has already got a net profit indicated above with the Indian business following debits and credits. And once you are hanged on to your debits and credits, then your MAT machinery starts. Is that okay? So let us make a note of all these things. First of all, because this question, a good question and with a good amount of notes. Okay. Question ID number 04. Question ID number 04. Okay. Netherlands Oil Corporation, a foreign company is assumed to have the status of non-resident, assumed to have the status of non-resident. Actually, I should not have used the word assumed to have non-resident, but that thing to be on the safer side, in my answer, I have used this kind of a language. I can straight away say that, no, this is a non-resident company. I can say like that, looking at the scenario, but right now we are not going into the depth of the residential status chapter. So we are, to be on the safer side, I'm just writing assumed to have a status of non-resident. Thus, it will be liable for taxation in India only for its Indian income. It will be liable to tax in India only for its Indian income. Okay. If India and Netherlands have a double taxation avoidance agreement treaty, if India and Netherlands have double taxation avoidance agreement treaty, then the test of permanent establishment is important to apply the MAT. That means if this company has got a permanent establishment in India, then the MAT will apply. If there is a treaty, okay? If India and Netherlands do not have double taxation avoidance agreement, if India and Netherlands do not have double taxation avoidance agreement, then the test of registration under any law in India will apply. In any case, it seems that the company has a PE in India and also liable for registration in India, and thus the MAT is applicable. And thus the MAT is applicable. Is that okay? And the MAT applies only to the Indian operations. That is to say, global taxation do not apply to this company. Okay. So update your answer, friends. So far so good. And this was the first ever conclusion with respect to your foreign company taxation of MAT in India. Okay. Now, having said that, we can start with our basic format of the answer. Computation of book profits. Profit as per P&L. 65 lakhs. Add less. Add less adjustments. Okay. After doing all these add less adjustments, you are going to get something called as a book profits. After getting the book profits, you will be doing the tax liability calculation. So you will say book profit, rate, amount, that means tax amount, tax, surcharge, cess, and the total. This is going to be your tax liability as per the provisions of the MAT. And this is your structure of the answer. Have a look at it. We start with the profit as per P&L, do the add less adjustments as per the format of the MAT. Because those adjustments of the MAT is already defined by the law under section 115 JB provisions, and that we got to use those provisions, which we had been doing it even for the earlier questions, friends. And then you get the book profits, you multiply with the rate. Here you have to remember one more thing also. It's a part of that particular, good part of that particular question, because it is a foreign company. Your MAT rate will be the normal MAT rate only. But when you will compute the normal tax liability, when you will be doing that normal tax liability calculations, at that point in time, you have to multiply the rates of the foreign company. Surcharge also, friends, for the foreign company is a separate rate. Indian company surcharge is a separate rate. So you have to keep that rate card, which I have already given it to you in my initial lectures. That rate card, now these rates which will be applied here will be with respect to the foreign company, because the given question is with respect to the foreign company. So that is the first ever caveat. So just keep this thing into the back memory and keep that rate card always handy with you for the purpose of answering it. Okay. So now we can go to the respective points and the respective adjustments. Okay. Net agricultural income in India. So agricultural income is covered under section 10. And because it is covered under section 10, it has to be excluded from the MAT provisions. And it is already told to you this is a net agricultural income. So it is gross minus the expenditure. Now conceptually, friends, in the MAT, we have to do that adjustment of expenditure and income separately. We should normally be showing the breakup, but nothing of that data is given to us in the question. So we can't use that. But we have to exclude it. We have to exclude it. So if you come here, this is our format of MAT. All the adjustments just come here, friends. Add adjustments. Okay. Expenditure relatable to section 10. So all the expenditure are added. The title is add. And in the less also same type entry is there. Most of the style of the drafting is same only. The relevant expense and the relevant incomes. Okay. So here also you have the section 10 income. That means expense addition separately you show, income reduction separately. Well, that means net figure get excluded here. Have you understood that? So what happens is that exempt in tax also becomes exempt in MAT. But the style in which it is to be calculated, style in which it is to be presented is like entire gross income you show separately, gross expenses you show separately with respect to section 10. But this question has not given us that data. Question has not given, so we cannot use it to that extent. So question has printed net figure. I will also use the net figure. Okay. Now for the students' advantage, I will write one note, friends. This is only for your advantage. I am going to do 1 second. Okay. General understanding of MAT. General understanding of MAT. Okay, only for your students, your advantage. I'm just actually it is not required, but only for your advantage. Okay. Exempt in tax. Just wait a minute. Look what I'm going to write. Exempt in MAT. Section 10. Section 10. Is it exempt under the tax laws? Yes, because section 10 by itself is the exemption provision. So I will say yes. It is exempt in tax. Is it exempt in MAT? Also yes. But what is the style of exemption under the MAT? The style, I will not call it as an exemption in MAT. I mean, that will not be a good English. So I will not like to follow that. But it is ultimately exemption because it gets excluded. Okay. So I am just writing in the bracket how it is exempt in MAT. It is excluded by adjustments. And this is actually the real purpose and the objective of the adjustments. What is the real purpose of the adjustments? Is this only that you want to exclude it. Why you want to exclude it? Because you don't want to tax it. Some people also think it like that taxable in MAT or not taxable in MAT. That also you can think. But whatever is excluded from the MAT, that means from the book profits, if there are any exclusions, net exclusions, okay. So presentation wise it is income showing separately, expenditure showing separately. But net though you are going to exclude it. And when you are going to exclude the net figure, that means that it is exempt in MAT. Or you can say removed from MAT, or you can say subtracted from MAT. Whatever language you want to use, you can use it. Have you understood that? Have you understood that? Okay. So something more I will write now. See, for example, section 10 AA. Just illustrative thing. Is it exempt in tax? Yeah, there is some exemption because section 10 is all about exemption. Yes, it is exempt in tax. But is it exempt in MAT? No. Because there are no adjustments with respect to section 10 AA type incomes. That means by default everything is included in our book profits. So under the MAT provisions, only section 10 incomes are given the benefit of exclusions via adjustments. But section 10 AA type is not given. Say for example, in the given question we have section 10B. Is it exempt in tax? The answer is no, because the government has already withdrawn the benefit now. Previously it was available, but now section 10B is not available. It is taxable in MAT. Sorry, taxable in normal tax provisions. It is also taxable in MAT provisions. That means it is not exempt. Our title is whether it is exempt in tax, so it is not exempt. Not exempt means it is taxable. Have you understood that? Okay. So this is how you got to understand and interpret all the provision of the MAT. Is that clear? Okay. So this was only illustrative thing, friends. For your advantage, I have written, as I already told you, that this is not required, but to make you understand how the MAT is giving exemptions. The MAT is giving exemption by exclusions, and that's the method. Actually, exemption is not the right word, but I think that will be a good word for classroom explanation purpose. Is that okay? So come to the question now. The question is saying that net agricultural income. So net agricultural income is covered by section 10. So this is already covered under section 10. So I got to exclude it. Okay. Now share of profits from a firm engaged in India. Share of profits is also covered under section 10. Okay. Amount withdrawn from a reserve. Okay, so that this point I'll take up afterwards. So first of all, these two easy adjustment of section 10. Let me just do that. Okay. Exempt incomes under section 10. Agricultural income. Agricultural income was 16. Share from firm. Amount is 15. Okay. So this is your less adjustment in the MAT provisions. Right now we are doing the computation of MAT. These are all credits. So credit means go in the less category by and large. Okay. Amount withdrawn from reserve. Very good point. Amount withdrawn from reserve few years back, which was created few years back. Now, few years back means logically the MAT provisions will be applicable in that particular year. The book profit was not increased, but the amount transferred to such reserve. Very good point. Normally, amount withdrawn from reserves are in the less category, normally. But if that will be less, only if in the past it was added in the earlier years. But it is already clearly stated in the question that this book profit was not increased, but the amount transferred to such reserves in that year. So in that year that would not increase. So this year we will not even reduce it. Okay. So come to this particular point. Amount withdrawn from reserve. The amount was how much? 3. Normally we less it, but we are not going to less it here because in the past the book profit was not increased by the reserve, by the transfer to reserve. And that provision is already supported also, friends. Come to this particular page. Amount transferred from reserve. This point. I already told you also, maybe in my previous class or one class before, I don't remember. But which is created out of the debits. So if that reserve was created out of the debits, that is one of the condition. Or if the MAT provision is applicable, it should have been added in the MAT provision in the earlier years. Either of the situation. That means if you are a very old company and you had those reserves of the years when the MAT did not exist, for example, so then the test of debits will be applicable. That such reserve should have been created out of the debits to the P&L. And if the MAT existed, then the test of it should have been added in the MAT provisions in the earlier years. Only then in the current year it will be subtracted. But the question is clearly printed that it was not added in the earlier years. Look at this. It was not increased. It was not, it was, 1 second, something wrong. Okay, 1 second. It was not increased. Okay. Next, 10B of the Income Tax Act and qualified for deduction. Okay. Now, as per the amended law, it is not possible to qualify. Section 10B benefit has already been withdrawn. So the question has printed that it is qualified. Question has printed, but we got to apply the law, not the question. So section 10B benefit has been withdrawn by the government. So question printed that profit from industrial undertaking approved and this and that and all that, but that section is only no longer there now. Okay. So you're not supposed to give any benefit under the normal provisions. Okay. But right now, friends, what we are doing is a book profit calculation. Now, in the book profit calculation, only section 10 is given the benefit. 10AA, 10A, 10B, etc. kind of provisions are not given any benefits under the MAT provisions. Look at this note that I have already written some time back. Look at this for your understanding purpose only I have written. Okay. So, only section 10 gets excluded from the MAT provisions and not any other incomes. Okay. So, for section 10B type incomes, no adjustments are required. No adjustment is required. That means the 65 lakh of rupees income or anyway includes all these things. No? Have you understood that? So, section 10B, no adjustments are required. Because only section 10 is adjusted. Section 10B is not adjusted. Okay. Now, next point. Profits from industrial undertaking covered and qualified under 80IC. Come to our table. Our general understanding. Example. Say for example, 80IC. Is it exempt in MAT? The answer is yes. It is exempt in tax. Sorry, not in MAT, tax. Is it exempt in tax? Yeah. But we will not call it as exemption. It is basically called as in form of a deduction. So here what I am discussing, don't catch the word exemption very seriously. Because under chapter 6A, 80IC is given a deduction. So that is one method in which the income get excluded from the total income calculation. So I'm just using the word deduction, or you can use the word benefit. So is there any benefit under the tax provision with respect to 80IC? Yes, because there is a specific provision. Correct? But is there any such provisions under the MAT? Under the MAT, there is no such adjustments required. That means it is not exempt in MAT, because when it is not excluded from the MAT, that means it is taxable in the MAT, because by default 65 lakh of rupees, your profit as per P&L includes all these figures and there is no exclusion. So if you come to this particular point here, are you supposed to do any adjustments here in the MAT provisions? There are no adjustments defined. These also no adjustments are defined. No adjustments are defined. Okay. That means logically all these figures are included in 65 lakhs. They are already included. And therefore it is taxable in the MAT provisions. Alright. Come on. So no such specific adjustment. Okay. Now let's come to the debits. Expenditure relating to 10B. So here also 10B. But we have already understood that in the MAT there is no adjustment. That means ultimately it is taxable in MAT. So nothing is to be excluded. So what treatment you have given to this? The same treatment. That is no adjustments. Now depreciation for the current year as per the Companies Act. Now for depreciation, there is always a special adjustment. Total depreciation add and the depreciation on cost less. However, if there is any depreciation, revaluation of the asset logically gets taxable in the MAT provisions. But in the given question, I don't think so there is any such data about revaluation of the assets. So to that extent, the adjustment should be simpler. I think nowhere it is given anything about revaluation. I don't think so. Okay. So what you have to do is you have to show total depreciation add and total depreciation less, because the entire depreciation is on the cost only, because there is no revaluation. This is fully on cost only. Okay. So show that adjustment. Okay. Add total depreciation 24, and here you have to say depreciation on cost 24. There is no revaluation. But you have to show these adjustments specifically add and less because of the specific provision. So as I already told you even in my previous class that this is more like a format computation. So you have to show the adjustment what is defined by the law. Okay. So defined adjustment you should better show. Come on, next point. This is done. Interest to financial institutions not paid up to the date of the filing of return. That means it is accrued in the books of accounts, but you haven't paid it. Now, this information is more important with respect to computation of total income, section 43B disallowance, if any, because certain deductions are available only upon the payment basis. But in the books of accounts, all these things are not there. So, books of accounts is indifferent. So, it's a proper accrual. That means the accounting system is done properly. Penalty for the infraction of law. That is also adjustment with respect to the total income. In the book profits, in the book calculation, all these expenditure gets debited. So there's nothing wrong with respect to that. Okay, proposed dividend. A dividend is one of the adjustment. So that will do. Then provision for taxation and income tax and the reserve for bad debts. So income tax we already know. And the reserve for bad debts, we need to discuss a little bit of extra point. Okay. So let me make up the notes. So far so good. Proposed dividend, taxation. That much, let me update the answer step by step, and thereafter I need to discuss. Okay. So, proposed dividend, provision for tax, and reserve for bad debts. Provision for tax given to us is 2, I guess. 1 second, let me check the amount. Provision for tax is 1, sorry, and the reserve for bad debts is also 1. Okay. This is 1, and this is also 1. Okay. Now the reserve for bad debts. I want you all guys to come to this point first of all. Come to that add points and this point. Amount set aside for the provision for the diminution in the value of the assets. I repeat, amount set aside for the provision for the diminution in the value of the assets. Here, little bit of extra attention is required, because this particular entry, which is provided by the law, provision for the diminution in the value of the asset. I just want to comment on one valuable thing, which is a very conceptual thing, friends. Pay maximum attention. See, there is something called as a reserve and something called as a provision. I believe that everyone knows the difference between the reserve and the provision. A provision means that you have a liability to pay the money. Reserve means you don't have a liability to pay the money. I repeat, reserve means you have no liability to pay the money. Provision means you have a liability to pay that particular money on whatever account. Is that clear? But sometimes the doubts come into picture. For example, you may say that there is a reserve for bad debts. Okay. Now, conceptually in the courtroom, there will always be a doubt. You will say it is a reserve for bad debts. Whether it will be categorized as a reserve or it is a provision. There is always a difference between a reserve for bad debts and the actual bad debts. There is a clear-cut difference. See, sometimes friends, in your accounts, what you do is, like you have a system, like outstanding debtors of that 2%, you make a provision for reserve for bad debts. Something like that you have. And you have that regular practice. Year by year, you make that particular provision. As a taxman, the officer will say that no, I cannot give you deduction for this as a standard practice. Because you have not actually lost the money. It is your accounting system that you are providing for X percentage on debtors or on sales or whatever. That's your accounting system. But actually, if the money is not bad, I'm not going to give you deduction. So there is always a difficult demarcation between the reserve and provision, or put it differently, between a good debt and a bad debt. The law of math makes it very, very clear that if there is any provision for the reduction in the value of the asset, if there is any provisions which are made for the reduction in the value of assets will be added. But only provisions will be added. And that too for the reduction in the value of the assets. If you are making provision for expenses, then this entry will not come. I repeat, if you are making provision for expenses, then this particular discussion will not come. This is only the provision for the reduction in the value of the assets. Debtors is your assets. I repeat, debtors is your assets. And if you are making any provision for the reduction in the value of the debtors, that is a reserve for bad debts. That will be hit by this particular provision. Baby. Alright. I once again repeat. If you are making any provision for expenses, they will not be coming in the discussion here. Only for the provisions for the reduction in the value of the assets, that will be covered by this entry. Okay. On top of that also, you can always discuss reserve for bad debts and the bad debts differently. Because if you are writing off bad debts, it is not a provision. Keep this in mind. A bad debts written off is not a provision because it is an actual bad. But if you are creating a provision for it, you have to adjust it. Okay. So, given question is about provision. The given question is all about provision. And so, I have to adjust it. So, come here, reserve for bad debts. Okay. So, this is the total figure that I'll have to add it. Okay. Next. So, this I have done. Transfer to general reserve. So, this is of course to be added. Provision for unascertained liabilities. This also we have already discussed in the past, but I will show you in the format also as a standard practice because I don't want my students to miss that. So, general reserve and unascertained liability. So, add, this is your unascertained liabilities and transfer to reserves, amount carried to any reserve by whatever name called. That is your these and these entry. Okay. So, amount transferred to reserve provision for unascertained liabilities. Two, let me go to the next point. Now, expenditure for ATIC, there is no such adjustment. That means it is already taxable in the MAT. So, ATIC, I think gross figure is it given to us? Yeah, this is ATIC, this figure and this figure. So, in the MAT, there is no adjustment. That means it is already taxable in MAT. In other words, the difference of net figure 1 is logically already included in 65 lakhs. This is already included in 65 lakhs because this 65 lakhs is after these debits and after these credits. So it is taxable figure, okay, in the MAT provision. But in normal computation, we will have to give the deduction, okay. So, no adjustment in the MAT. That means it is anyway included. Let it be included, okay. So we do not require any such adjustment further. Following additional information is provided. The meaning of the word additional information basically means that it is not part of your debits and credits. So it is like extra. It is not part of your P&L. This is how we should understand the interpretation of the question. Whenever it is said additional information, that means it is not in the P&L. Just a simple question interpretation I am telling you. Now you have been given a brought forward book loss. It is as per the books. Depreciation as per income tax rule. So this is as per income tax, okay. And brought forward business loss, unabsorbed depreciation as per income tax law. So this is a brought forward figure. So you have been given a brought forward figure as per income tax, separate number, and brought forward book loss. Okay. So as per the books, you are given only the losses. You are not given the breakup of depreciation or book loss. You are not given that breakup. So come to this point. Let me come to this page of less. These are the relevant points with respect to your brought forward losses in the books. So in the MAT calculation, you got to go with the book numbers. Okay. If you are covered by insolvency and bankruptcy code, then it is aggregate figure. But if you are not covered by the, insolvency or the bankruptcy code, that means it is amount of the loss or the unabsorbed depreciation, whichever is less. So loss or the depreciation, whichever is less. Now, if you read this particular question has told you loss is 12, but question is silent about depreciation, or rather question is not printed or whatever. You have to take whichever is less. You don't have to take the aggregate figure. You don't have to take the total number, because our given company is not covered by insolvency in the bankruptcy code. Our company is not covered that way in the question, that our Netherlands Oil Corporation. So what to do now? So I think that the best way to proceed is that let us assume that the depreciation is nil. The second good thing which I am just telling you with respect to the books of accounts. Normally, this figure is your profit and loss appropriation account, normally in the books of accounts. So this figure is always an opening balance. Supposing if it is on the debit side, it will represent brought forward book loss. In the brought forward book loss, you do not have like condition how many years set off and all that. No such conditions there. It is brought forward book loss. So this figure, P&L appropriation account, you need to break it up between how much is loss, how much is depreciation. Normally accounts don't require you to do this, but you have to do it if you are claiming any benefits under the MAT provisions. So either you should have the breakups, or if you do not have the breakups, then you have to write a suitable note. Assume that depreciation is nil. So if you assume it nil, whichever is less is nil. That means you are not going to get any benefit under the MAT provision for the carry forward set off of the book losses. Okay, so come to that less adjustment. Brought forward loss, depreciation, the loss is 12, depreciation is nil assumed, whichever is less. So it is nil only. Have you got this? Whichever is nil. Whichever is less. So whichever ultimate answer what you get is nil. Let us proceed with the question. So I've used this data. Depreciation as per income tax rules. So that income tax provisions will come. Book depreciation and the tax depreciation, that will come in the total income calculations. In the books, we don't do that. And brought forward business loss unobserved depreciation as per income tax law is given. So that is the income tax carry forward set off. And for income tax, we have already given the breakup of how much is loss and how much is depreciation. So that we will use it in our income tax carry forward and set off, not right now. Company has got a brought forward tax credit from 3 years back, rupees 5 lakhs. Oh my God. This question is also going to test your knowledge of carry forward set off of the tax credits. Good point. But this adjustment will come almost towards the end of the, what should I say, discussion. Shall I? So I'll keep it pending for a while. So I think the entire question has been summarized from the math point of view. So we can straight away go and use our calculator now. Come on, quickly. Use the calculator. Total 36 here. The less. Net book profit. Now here you have to be cautious. Update your answer. So far so good, friends. Now, this is already a foreign company, and since it is a foreign company, you have to apply the rate of surcharge with respect to the foreign company if it is applicable. Okay. So surcharge is applicable only if your total income exceeds a particular number. Okay. So that is there in your rate card. Open your rate card, friends, immediately and check it out whether surcharge apply or not apply. But if at all it apply, you have to apply only with respect to the foreign company because this is a foreign company. However, in the MAT provisions, there is no separate MAT rate for the foreign company. So the MAT rate of the foreign company and MAT rate of the Indian company is the same. Although in the normal tax regime, there are separate rates with respect to Indian company and the foreign company, but no such separation is done with respect to the MAT provisions. So you just multiply the tax book profit with the book profit rate, that means your tax rate for MAT provisions, and get the tax liability, surcharge and the cess numbers. And all these numbers you will get from your rate cards. You just have to use your calculator, multiply and proceed. Is that okay? Now let me start with the same to same question and the further discussion with respect to total income computation. Computation of the total income and the tax liability that we will compare it with your MAT obligations, and then we'll be taking the decision for the net tax liability, but that will be a second stage of the discussion now. The first paragraph, the basic discussion that we have already done with respect to the taxation of the foreign company will remain as it is, even in the total income, that you are a foreign income, you are a foreign company and you have Indian income, you have a foreign income, your residential status is non-resident, and because of that you will be liable to tax only for your Indian incomes. That's a very hardcore basics of the scope of the total income, and we got to follow again the same to same format of computation, starting with profit as per P&L 65 lakhs of rupees. So I can open up my answer. Come on, darling. Okay, so computation of total income. So I'm not repeating those notes with respect to the foreign company, and that basic note that I've written before is the same. Okay, computation of total income. Profit as per P&L 65 lakhs. Add less adjustments. There is one more thing that I will tell you, a very small thing, I mean a not so great thing, but I will tell you that the presentation of the answer. Okay, look at this, the MAT presentation of the answer. In the MAT presentation of the answer, we have already done add separately, then less separately. We have taken that internal total and kind of things. That is a very correct presentation with respect to MAT, because MAT is like a format computation. So keep all the add adjustments as grouped separately, keep all the less adjustments as grouped, keep it separately. Okay, so because this is format type defined under the law that way, and this is how you have to certify also as a chartered accountant, because for that there is a certification and the certificate is also in the same format. So this is practically the same format of the certificate that we have already followed. But when it comes to your normal computation of the total income, nothing like that. So here you can say add less adjustment. You can just follow one sequence. You may not have that internal totals, internal columns and all that. Straight away keep on doing that particular adjustment. Okay, come on, go ahead step by step. Net agricultural income, so that will be exempt, section 10. Share of profits from the firm, section 10 exemption. So this also will give the exemption. Amount withdrawn from reserve few years back. Now any amount which is withdrawn from a reserve, any amount which is withdrawn from the reserve is not an income. It is not an income of the assessee. The test of, like, in the earlier years it was added in the MAT provisions, that was only with respect to MAT. In the normal tax calculations, in the normal total income calculations, correct, you don't have any such things like in the previous year have you created that reserve. It is only the reserves returned back, and the reserves returned back is not a income. Okay, so it will get excluded. So let me open up my answer. Share of net agricultural income. Net agricultural income. Under section 10 exempt. So reduce 16. Share of profits from the firm. Again under section 10 reduce 15. Amount withdrawn from reserve is not the income of the assessee. So reduce 3. Okay. proceed. Section 10B. Now this section 10B is a bit dicey because of the language of the question. It is little bit dicey. Section 10B is already withdrawn by the government. So we will say that we are solving this question for our previous year. Our previous year government has withdrawn. So company says that it is qualified under blah 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 blah. But law doesn't say that. Company says that. Law don't say that. So we'll follow the law. We'll not follow the company. So this particular profits, section 10B, will say it is taxable. That means it is not exempt. And profit from Sikkim, this ATIC, yeah, that is eligible. But that is eligible in the sense that we'll have to do that net figure. That was 6, 5. And because we are doing computation of the total income, now we have to be more particular, like heads of income. Head 1, head 2, head 3. Then the GTI. Then from the GTI, you will give the deduction. So that kind of situation will grow. Okay. So I'll have to do that kind of a spacing and all that things. Okay. So let me do that. Undertaking of 10B. No benefit is given by the law. So no adjustment because it is already included in 65 lakhs. Okay. Then I'll have to leave some spacing. Quite a good space I will leave. So somewhere at the bottom line only I will say, okay, so this is my gross total income. Then deductions. Then the total income. A TIC was printed and the net figure was 6 minus 5. So 1. And I've left some handsome space so that there is nothing wrong with the spacing. So check out your answer, friends. So far, so good. This is how your structure of the answer look like. You started with profit as per P&L, then you have done few adjustments. Then after doing all the adjustments, headwise and all that, you will get a gross total income, then again a deduction, then there is a total income. Okay. Let me go to the next point. Expenditure relating to 10B. So treatment of the 10B income is same as 10B expenditure. So ultimately that figure is taxable. That means you don't have to do any adjustment. It's a taxable profit. So depreciation for the current year. So this is going to be your book depreciation. So book depreciation and depreciation allowable under the income tax rules. Separately, that number is already given to us. That's a separate number. So book depreciation add and the income tax depreciation less. Standard format, standard computation. So let us proceed. Depreciation as per the books. Depreciation as per income tax. Book depreciation add and the income tax depreciation less. Okay, come on, next. Interest to financial institutions not paid up to the due date of the filing of return. So this is not paid up. That means under section 43B, certain deductions are allowed only upon the payment basis. That means you pay it and you get the deduction. In the given situation, you haven't paid it, so you will not get the deduction. But you have already debited to the P&L. You have already debited this figure to the P&L, so I'll have to add it. Penalty for the infraction of law is not allowed as a deduction, but you have already debited to the P&L, so I have to add it back to the income. Proposed dividend is also not allowed. It is not expenditure item, so no question of any deduction, but you have already debited to the P&L, so I'm going to add it back as a matter of adjustment to the total income. Then the provision for taxation and the reserve for bad debts also comes in the same category. Income tax is not allowed as a deduction, so I'm going to add it back. Reserve for bad debts is not allowed as a deduction. However, actual bad debts would have been allowed, but actual bad debts data is not given to us in the question. I'm going to do this particular adjustment, but friends, before that, let me tell you that this question is almost a full-fledged 16 mark examination questions. So it's going to have a lot of mind toggling. And one thing which I'm just telling you, sometimes in examination condition, if you don't know one or two, some kind of adjustment, don't get scared, leave it, finish your answer as far as possible. And those adjustments, one or two, supposing if you don't know or don't remember or something like that, leave it hanging till the end of the answer, because sometimes what happens, that when you are solving the question, some connecting point comes and immediately the things will flash into your mind and you will get the clue. So don't get scared at the first reading of the question. Just start solving it and you will get the answer. You will get the answer, baby. I'm telling you. Nobody can stop you. So, interest to financial institutions, penalty for infraction for law, proposed dividend, and provision for income tax, and the reserve for bad debts. Let me do this much of adjustment, or maybe even transfer to reserves. I can take it up. But that is not an expense item. Okay. Interest to financial institution, not paid. So 43B section disallowance will come. Add it to the income because it is not an expense item, and a small point to be noted and repeated is that it is already debited to the P&L, so we need the addition. Penalty for infraction of law, that is one, not an allowable item. Proposed dividend, add. Provision for income tax and reserve for bad debts, total is 2. Transfer to general reserve, 5. Not all expenditure item. Let us proceed further. Provision for unascertained liabilities. That is also unascertained liabilities. Even income tax is not going to give you deduction. And moment this word unascertained liability comes, conceptually, lot of courtroom discussion, the difference between provision and reserve. If it is an unascertained liability, listen to this very carefully. The word which is used in the question is called as the provision. This is how it is to be interpreted. Conceptual interpretation, I am telling you. The word which is used in the question is a provision. But it is a provision for unascertained liability. That means you don't have a liability. So it is as good as like a reserve. In interpretation, your presentation in the books may be still the provision only. But a taxman will say that no, this is not a correct provision. That means you have not ascertained, that means you have no liability to pay. But you are just debiting just by journal entries so that you want to reduce your profits. This is what corporates do, make unnecessary provisions. to reduce the profits. So the word which is used in the question is a provision, but it is to the taxman, it is not a provision, it is a reserve. So it is unascertained liability. Supposing the language was provision for expenses, then I will say, okay, it is a genuine situation, so I will allow it. So provision for expenses is a separate situation, and provision for unascertained liability is a separate situation. Is that clear, baby? So this is not a allowable, this is not a correct provision. This is not, rather it is a reserve. That way you can say. Okay. And expenditure for relating to ATIC undertaking, that we have already considered, that net figure. Okay. So come on. Provision for unascertained liability, and that is 2. Following additional information is provided. Brought forward book loss, so we have used this particular data in the MAT provisions. Depreciation allowable over income tax rules, that we have already done the adjustment with book depreciation add and the tax depreciation less. That is also done. Now brought forward business loss and unabsorbed depreciation as per income tax law, loss and depreciation. Under income tax law, the loss is also allowed and the depreciation is also allowed. Only thing that there are some, what should I say, the years limitation. But that exact data is not printed, that your business loss is how many years old. Okay, so let's not dispute with those kind of points. So we will say that years and timelines and all that are not in the question. So it is a business loss allowable for set off. Depreciation, so there is no number of years condition, but it is allowable for set off. We will say that it is allowable for set off, and there are tax numbers, breakups available, and both of them is available. Because under normal total income, it is not like whichever is less. It is both of them available on merits. So loss is 7 and depreciation. Okay. So brought forward loss. Okay, so this is loss is 7. The depreciation is 10. Total is 70. Okay, so all the data that we have already used. Come on, start using your calculator now. I think we are already done with the question. Company has a brought forward tax credit, and that adjustment will come when we do the tax liability calculation. So that doesn't come right now. So now we got to start using our calculator, get the total income figure in the topmost priority, and come to this. Okay, so you have 65. Come on, take the totals. Gross total income, and the total income. Let us now start with the tax liability calculation. Total income, rate of tax, the tax in the rupees terms, tax, surcharge, and the cess. total. Here, what is the amount? Total income is 26. Now friends, you got to start using your calculator. So you'll have to multiply the rates of the foreign company now, because this our assessee is a foreign company. Surcharge will be applicable at the rates applicable to the foreign company, but subject to the conditions of the surcharge itself. That surcharge is applicable only if your income exceeds a limit. Otherwise, the surcharge is not applicable. Okay, but don't forget that this is with respect to a foreign company. And so, the tax rates of the foreign company will be applicable for the purpose of multiplication. And there is no differentiation between the cess. Okay. Now, the company has already got a brought forward tax credit. Now, first of all, you got to check out in this particular answer that which tax liability is more. Whether tax liability as per the total income is more, or the tax liability as per, the MAT provisions are greater. Check out the amount. If the tax liability as per total income is more, I repeat, if the tax liability as per the total income is more, only then the set-off can be allowed. Okay, and it will be allowed only to the extent of the maximum of the difference between the tax on total income and the tax on MAT profits, subject to the available credits. So what is the maximum permissible set-off? That is the difference, and the actual set-off will depend upon your actual available tax credit, which in the question is rupees 5 lakhs. So come on, check out. See here, approximately in this particular question, we have the tax liability as per normal provisions is about 10 lakhs or something like that. And as per the MAT, it is about 9 lakhs. So I'm paying 1 lakh rupee more than the MAT liability. So that can be the maximum permissible set-off. But my available tax credit is how much? My available tax credit is 5 lakhs. So from the 5 lakhs, that approximately 1 lakh and some odd number, that much I will set it off. And the balance will be carried forward to the subsequent years. Because carry forward and set off of the tax credit is allowed for definite number of years. It is not for unlimited number of years. It is for the defined number of years. And as given in the question, I think the 3 years old, it is already a credit. So for the balance number of years, that credit will be carried forward to the subsequent years. So now check up your exact numbers. Use your calculator. And here students oftenly do that mistake that you should not do. The maximum permissible set-off is the difference between tax on total income minus the tax on MAT. That means book profits. That is maximum permissible set-off. The difference. And that maximum permissible is subjected to the actual available credit, which is 5 lakhs in the given question. So if you cannot set off the full 5 lakhs, then the balance you have to carry forward to the subsequent years for the subsequent year set-off.